Okay, let's dive right into a massive financial mystery that's honestly affecting millions of households right now. So in 2025, the Reserve Bank of India, the RBI, did something pretty remarkable. They cut interest rates 4 separate times, which totals a massive 125 basis points. That is literally the biggest rate cutting cycle we've seen since 2019. In plain English, the cost of borrowing money absolutely plummeted. And, well, if you've got a home loan, you should definitely be celebrating with lower monthly payments. But here's the big mystery at the heart of this explainer. Why exactly haven't those savings shown up in your bank account yet?
Just look at this timeline. It really tells the story of a super aggressive central bank. We started off in February with a repo rate at 6.50%, and then these steady cuts just kept rolling in. By April, it was down to 6%. In June, we saw a big drop to 5.5%. And finally, by December, the rate settled at 5.25%, which is a multi-year low. Make no mistake, this was an easing cycle specifically designed to make money cheaper and literally put cash back into the pockets of everyday citizens.
So the absolute most crucial question we need to ask is this. Did your EMI actually go down? Did your equated monthly installment shrink at all? For millions of hardworking Indians, the honest and highly frustrating answer is a resounding no. Or, maybe it dropped by a tiny, almost insulting fraction. You're sitting there, seeing all this news about historic rate cuts, but your monthly bank statement just hasn't budged. And honestly, the craziest part? The reason has absolutely nothing to do with the RBI and quite literally everything to do with the fine print you signed.
Let's ground this macroeconomic lesson into your personal reality for a second. Just look at the sheer amount of money we're talking about here. If you have a standard 50 lakh home loan on a 20-year tenure, a 125 basis point cut isn't just some abstract percentage on a graph. It equals exactly 3,050 rupees in savings every single month. Over the entire life of your loan, that adds up to 7.34 lakhs that should be staying in your pocket, not padding the bank's bottom line. So, what's the structural culprit behind this whole vanishing savings act? It actually comes down to three completely different parallel loan systems operating in India right now. What this means is that you and your neighbor could have the exact same loan amount from the exact same bank, but because you took your loans out in different years, you experience the RBI's economic policy completely differently. It all boils down to base rate, MCLR, and EBLR. Let's break these down.
We're going to start with the absolute oldest of the bunch, the base rate. If you got your home loan before April 2016, you might actually still be trapped here. Now, what's crucial to understand about the base rate is just how incredibly opaque it is. It relies on a bank's own internal costs, giving them a really high level of discretion. And what does that mean for you? Well, it means that despite that massive 125 basis point cut in 2025, base rate borrowers saw virtually zero transmission. The bank simply chose not to pass those savings on to you.
All right, let's look at the middle generation. System 2, known as MCLR, or the marginal cost of funds-based lending rate. If you signed your loan papers somewhere between April 2016 and October 2019, this is very likely where you're sitting. Now, MCLR was originally supposed to fix the transparency issues of the old base rate, but instead, it essentially became a trap of delayed transmission. Millions of borrowers are currently stuck in this system, completely isolated from the RBI's recent rate cuts.
Here is exactly how this MCLR trap works, step by step. First, the bank argues that their internal cost of funds, basically what they pay their depositors, is still high. Second, because they say their costs are high, they delay cutting the MCLR rate. But here is the most insidious part, step 3. Even when the bank finally does get around to lowering the rate, your specific loan doesn't update until its annual reset date. So if the RBI cuts rates in February, but your loan anniversary isn't until, say, November, you are stuck paying that higher rate for 9 long months. The end result of all this is a stark mathematical injustice. The RBI delivered a massive 125 basis point cut. But if you're an MCLR borrower, all those delays, those internal bank calculations, and those arbitrary anniversary dates mean that only about 20 to 30 basis points actually reached you. You are missing out on nearly a full percentage point of savings. The transmission of the central bank's policy is, for all intents and purposes, entirely broken for you. Enter the modern solution. System 3, the EBLR, or External Benchmark Lending Rate. Introduced for loans after October 2019, this system literally changes everything. It's directly linked to an external benchmark, which is almost always the RBI's repo rate itself. There are no shady internal bank calculations. There's no waiting around for a yearly anniversary. It features an automatic 3-month reset. So if the RBI cuts rates,
EBLR borrowers see the full benefit reflected in their EMI within a maximum of 90 days. It's totally transparent and it's instant. Now, you might be wondering, why on earth did banks drag their feet so much with those older systems? Shockingly, or maybe not so shockingly, it comes down to protecting their own profits. Banks operate on something called the net interest margin. That's just the profit difference between what they charge you for a loan and what they pay out to people holding fixed deposits. Because the interest they pay on those deposits doesn't fall as fast as the RBI repo rate, passing on instant cuts to borrowers would temporarily squeeze their profit margins. So under MCLR, they naturally just protected their own margins, right, at your expense.
Let's ground this in a pretty devastating real-world comparison. Take a look at Vikram and Priya. They both took out identical 60 lakh loans for 20 years from the exact same bank. They have the exact same credit score and they live in the exact same city. Literally everything is identical. But Vikram took his loan in 2018 under MCLR, while Priya took hers in 2021 under EBLR. Today, because of the broken transmission in MCLR, Vikram's effective rate is stuck up at roughly 8.9%. Priya's rate, adjusting instantly with the RBI, has dropped down to 8.5%. That is a 0.4% discrepancy simply because of the benchmark system written on their paperwork.
I really want you to just let this number sink in for a second. Over the 20-year lifespan of that 60 lakh loan, that 0.4% difference means Vikram is going to pay a staggering 10.5 lakhs more than Priya. 10.5 lakhs, all because he's passively sitting in an outdated MCLR system while she's in the modern EBLR system. Guys, that is life-changing money being left on the table.
Okay, enough of the problem. Let's dive right into the resolution because you absolutely have the power to fix this right now. Here is your fast-paced 4-step action plan. Step 1, check your loan statement today. Are you on base rate, MCLR, or EBLR? Step 2, calculate the gap. Ask your bank for their current EBLR rate and see if it's 0.5% or more below your current rate. Step 3, if it is, explicitly ask your bank to switch your loan to EBLR. And step 4, if your bank refuses or drags its feet, strongly consider a balance transfer to a completely new bank that will actually give you that transparent rate.
Now, when you ask to switch, your bank is probably going to quote you a one-time conversion fee, usually somewhere between 5,000 and 15,000 rupees. Use this simple switch test to make your decision. Divide your projected monthly savings by that fee. If you'll recover the cost of the fee in under 12 months of EMI savings, do not hesitate. Make the switch immediately. Oh, and keep in mind that fee is very often negotiable with your relationship manager, especially if you have a solid repayment history.
Let's just zoom out for a second to see how this impacts all of us on a macro level. There are 150 million Indians currently paying off home loans. A massive portion of them are trapped in these older base rate and MCLR systems. When 150 million people are overpaying their banks instead of saving that 3,050 rupees a month, they aren't spending that money in the broader economy. They aren't buying goods, they aren't investing, and the RBI's entire monetary policy fails to stimulate the country the way it was designed to.
The absolute bottom line in this explainer is this. Nobody is looking out for your wallet except you. Your bank isn't going to call you up to offer a lower rate, and the RBI sure isn't going to text you an alert. True financial power comes from actually understanding the fine print. So I'm going to leave you with this final provocative question. Right now, as you watch this, exactly what benchmark is legally attached to your biggest debt? Go check your paperwork today and claim the savings that are rightfully yours.